All right. Welcome back to another episode of the Real Estate Investing Club. I hope you guys are having a great week. It is Wednesday here and it is nice and rainy outside. Us Seattleites, we love our rain. So I'm super stoked. It is a good day for a second reason because we got Travis Watts with us on the show from Ashcroft Capital. Travis is an LP through and through. He invests in other people's deals. So this will be a unique opportunity to understand those of you out there who really want to be a passive investor and only put your money into other deals to generate, get the same benefits that other GPs get from investing in deals. This is the opportunity to get that perspective. So Travis, thanks for hopping on the show.
Hey Gabe, thanks for the invite. Thrilled to be here.
Absolutely. I told you before we got on here, we always like starting with stories and hearing how people got to where they are. So why don't you take us to the beginning of your story in real estate and tell us how'd you get here?
Yeah, happy to. It's kind of an interesting story, really. So my parents split when I was 5 years old. We were out in Colorado, and I'd see my dad a little bit during the summer, and every other weekend. And he was a big garage sailor, and he still is to this day. And so, we were out at a garage sale, and I was kind of a nerdy kid, and I was into just math and numbers and just kind of investing before I was an investor, really. So he found a book. It was written by Robert Kiyosaki, but it was not Rich Dad, Poor Dad. It was one of the others in the series. And so I picked that up at a very early age. I must have been in, I don't know, junior high or high school or something. And it just kind of planted a seed as to why you might consider becoming an investor or why you might consider passive income. And then some other things I didn't understand at the time, like taxes and whatnot. So I planted that seed. And I thought, yeah, maybe real estate's going to be a fun thing to play with one day. Didn't have the money, of course, so wasn't in any type of position to get started. But several years later, 2008, 9, and 10 happened. And so it's basically the summer of 2009, and I was looking to move out on my own, and I had to make a decision. Am I going to be a renter or an owner? And it's funny and ironic because everybody I asked in my family and friends and network said, absolutely don't buy a home. It's a horrible decision, right? We're underwater on our house. I mean, everyone's losing their homes. Don't buy a home. That's crazy. So I bought a home. And and I did that because, I was just looking at basic fundamentals. I'm like, okay, this thing sold at 200,000 a couple of years ago, and now it's 95,000 right now. So I bought it. And I thought, worst case scenario, I'll get a roommate, and that'll help me cover my bills and expenses if anything went wrong, and I'm buying at a discount. So that was 2009. Got in to a little townhome, 2-bed, 1-bath in Colorado, next to Colorado State University. And that roommate, I ended up actually doing that. And that's what really opened the door for me on passive income, because all of a sudden someone's handing me this check on the first of the month for, it was like $600 or something to rent a room. And I thought, man, $600 in my world back then was a big deal. And I was like, how do I scale this? Can I have 100 roommates? So instead, I started buying single family homes and flips and vacation rentals. I did that for 6.5 years. And then I burned out of doing everything myself. And that's when I became a limited partner, which is what I still am today and what I intend to be for the foreseeable future indefinitely. And so I partner now with other people who are experts in the field doing their own deals. And still after that passive income and the tax advantages and the leverage and all the cool benefits, but without having to do it on my own, because I really got burned in that process in many ways.
Yeah. And you said, you mentioned having that roommate was the first taste of passive income, but yeah, I would say that anytime you own property, if you're the GP, if you are the main person that is responsible for getting the deal done, that's not passive income. Passive income is really on the LP side. That is where you put your money. The real work comes into selecting the partner, selecting the person to partner with, and then vetting the deal. And then after that, it really does become passive income because your job is done. And so, it's one of the things when people talk about getting into real estate, they always think about buying a single family house, buying a property, and they never really think about investing in other people's deals. And
Right.
it is a great opportunity for people who want to keep that W-2. So how much it isn't something that you can come into without capital. Sometimes real estate you can get into it with very low amount of capital, but being an LP, you do have to have money because that's the value you're bringing to the deal. How much money did you have when you got into your first limited partner deal?
Yeah, this is a good point to bring up. And, I hadn't done a lot of analysis really on my own portfolio and net worth and metrics and all this stuff until a certain point. And that certain point was I was working in oil and gas. I was working 14 hours a day, 98 hours per week consistently. And I was
Yikes.
starting to burn out on that too, in
And what
addition to doing
can I
all.
ask, what were you doing in oil and gas?
Yeah, I ran a safety program for oil and gas service company. Ended up
Hmm.
over in Saudi Arabia at the tail end of it, and so I
Oh
was
wow.
away from home for a month at a time. And it just, yeah, I could see the writing on the wall. I was like, man, I can't stick this out. And so I was looking for alternatives to replace my income or my job. And so I thought, okay, if I quit doing all these flips and all these do-it-yourself projects from afar and having to pull my friends and family in, how much could I reasonably achieve in terms of passive income doing these syndications? And, I've said this many times, many ways, but I think when folks get to the $1 million threshold of being able to have that much net worth or that much to invest, this business model really starts to make a lot of sense. Okay,
Yeah.
because in 2015, when I started doing the LP stuff, it was not uncommon for cash flow to be 8% a year in your first year, and then 9%, then 10%, and it just grows. So you start to think about $80,000 per year in passive income. That starts to be a little bit life changing for many of us.
Yeah.
If you're getting started with 5 grand, what's $20 a month going to do for you, right? Go get you a burrito or something. So anyway, long story short, I started selling off my single family home portfolio one at a time. And as these deals would sell, I would go into other people's deals with usually their minimum investment, just to be transparent on that. It'd be 50,000,
50,000, yeah.
25,000, 75,000, stuff like that. So I hyper diversified for many years. And then it became kind of an accounting nightmare. so, so now I've kind of scaled back to investing with just the groups that have just under promise, over delivered, and just done the right things and had great performance and transparency and communication, stuff like that. So I'm doing larger amounts with fewer operators now. But anyway, that's how my story unfolded thus
Yeah,
far.
yeah. And I feel like that's a good benchmark for people, because when you're thinking about investing passively, it really doesn't make sense unless you have a sizable liquid
Yeah.
cash that you can put into another deal. And $1 million, that makes sense to me as well, because if you have anything less, I mean, you can have less, but it wouldn't be something that you can um, retire from, I guess, like leave your W-2 from.
Yeah, I
So
think it really depends on what the individual's goals are. Like I said, I was trying to leave a job or figure out how I was going to support myself without oil and gas income. And so that made sense, to your point. If I had 10 grand to work with, that wasn't going to help me in any way. So,
so once you once someone gets the amount of money they need, they do their own calculations, they have the cash available to put into deals. The next step is actually finding that deal, finding that jockey, that general partner to partner with. How did you go about selecting a general partner?
it's a good question. There's really, to me, there's three primary categories that I look at and I vet when it comes to investing in a syndication. You have the operator, which you refer to there as the jockey, and I love that because I bet on the jockey, not the horse being the deal. So I put about a 50% emphasis on the operator. What's their track record? Who are they? How do they communicate? What deals they do? Does that match my criteria? All that good stuff. And then I put about 25% on the market because I can't be an expert in all markets. So I have to kind of go off their research and what they're projecting and what data they have. And then you have the deal itself. And I think, myself included, but I see this among many LPs in the industry. a lot of people, I believe, put too much emphasis on the deal, saying, tell me everything about the deal. What's the deal? What are the numbers? I want to deal with the highest returns. Well, if the operator doesn't know what they're doing, forget about the projected returns. you know, deals are definitely important, and you have to do your due diligence. But I would put it somewhere in like a 25% category overall. And so that's kind of my high level answer to
Yeah.
how I go about it. You've got to start as an LP, in my opinion, creating your own criteria, making your own decisions. Now, how do you do that? Well, podcasts like this help, where people are on here articulating criteria and what they look for and all that kind of stuff. But it's highly personal, because I know plenty of LPs who could care less about cash flow. Maybe they're using a self-directed IRA account. They're not going to touch that for 30 years. They don't care about a deal that's going to be held for 3 to 5 years if it cash flows or not, because they're not using that account for anything. So they might go do like a new development deal or something like that. I know other folks like myself that are heavily cash flow focused because it's our primary source of income. And so I will not invest in a deal that doesn't offer projected cash flow. That's just a personal preference. That doesn't mean deals that don't cash flow are no good. It just doesn't meet my criteria. So, read some books, listen to some podcasts, find a mentor, join a mastermind, stuff like that, and just start to jot down what's important to you. What do
Yeah.
you value?
Yeah. Yeah. And I like that you put a greater emphasis on the operator because, things are going to go wrong in every single deal. Not necessarily wrong, but just things will happen in the course of repositioning an asset that you don't expect,
Yeah.
because you can't know everything, and you just need to trust that the general partner is intelligent enough and dedicated enough to find a solution to that problem. The underwriting is one thing, but they really need to be able to solve the problems as they come up. So yeah, I like that you put a greater emphasis on the operator, because that makes a huge difference. And then 25% on the market. That is interesting. I actually would have put more emphasis on the deal itself, but you really like looking into the market. What do you look for? Or I guess take us specifically when you're looking at a deal, what are you looking for in that market section?
Yeah, I will first share a very short story to help paint the picture as to why I label it as 25%. I did a deal back in roughly 2016 with an operator on the outskirts of Atlanta, Georgia. And at the time, and it still continues to pretty much be this, but it was a very growing market, right? It was a fantastic time to dip into that market. Well,
What was the market?
the specific city,
Yeah.
I want to say it was like Alfreda or something like that.
Okay.
I don't
It
know.
was
I've
a
never
suburb.
been there,
Yeah.
so I'm not sure.
Yeah.
But anyway, yeah, outskirts of Atlanta. I do remember that. But anyway, the operator, it was new. It was like their first or second large deal, and they just couldn't execute the business plan, basically. They couldn't turn the units. They hired the wrong property manager. There's lots of things, to your point, that went wrong. And the deal was an okay deal, but the point is that the market really lifted us through the next
Mm.
couple years, helped boost the valuation, helped boost the rents without the operator really having to do anything. And we got out of that deal successfully, but not at what we were hoping to achieve in terms of the projected returns. It was roughly half of what was projected. But still, I'm not complaining about it. I'm just saying the market in that case was that third leg that really helped out.
Yeah.
Had the market been flat or in decline, we all would have lost our money. So it is important, and you want to. What do I look for in markets? Um, Primarily, where are people and businesses relocating to? Is it landlord friendly? Is it tax friendly? What are the school ratings? What are the crime metrics? What's the immediate 3 mile radius? I think that's super important when it comes to multifamily. I've seen apartment buildings that look great on paper, but you go run like a Google Maps and it's next to like a junkyard, or it's next to, the city dump or something. It's like no one wants to live there. So yeah, always, if you're not going to visit the property, which I try to do as much as I can, I didn't in that case, but Google Maps it at least, and read some of the reviews. Take the reviews with a grain of salt, because people are much more inclined to complain than they are to write a great review. But
That's for sure.
just if it's something about that can't be changed, like the proximity or the crime or something like that, if it's management or maintenance issues, these things can be addressed. But you can't move the location of the property. So
Yeah, that makes a lot
think
of sense. Yeah, if you invested in Dallas 10 years ago versus Baltimore 10 years ago, I'm sure you could make a lot of mistakes in the Dallas market and still still make a little bit of money.
there you go. Yeah, it's
All
true.
right. So that kind of brings us to the asset. You chose multifamily. Have you invested in other assets, industrial, self storage, or did you choose specifically to only look at multifamily?
Yeah, the reason that multifamily has been and will probably remain kind of my bread and butter is because it was an easy transition coming from residential single family to residential multifamily. And I always did value add business plans on the real estate that I owned individually. So that's why I like, value add business plans. And I just wanted to be in other markets besides Colorado. I had all my properties in like a 30-mile radius, and I started to get antsy about that. What if I don't know, politics change? What if natural disasters happen? I didn't want all my eggs in one basket. So yes, I've invested in mobile home parks and car washes and self storage and land and notes and REITs, and I mean there's a lot of different things that I've invested in, but multifamily value add has been the bread and butter. And the philosophy is, to me, invest primarily in what you know and understand the best, and then diversify from there. I think that, I forget who quoted it, but the more knowledge you have in something, the lower your risk profile goes down. So you don't want to be out there taking huge bets and chances, not knowing what you're doing.
Yeah, makes sense. So going further into that 25% about the deal, choosing the asset is one thing. What else do you look for when you're looking at their underwriting?
Yeah, basically, and it's well, I say it's funny. It's not really funny, but the last couple of years have been tough on a lot of us. A lot of deals have had to have capital calls and pause distributions. We've seen some foreclosures. It's not been happy. And thankfully, in my opinion, we're now entering the other side of this, right? We basically had a commercial real estate recession, and it was a capital market recession. It had everything to do with interest rates going up hard and fast, and a lot of adjustable loans out there, and a lot of distress because of it. So it wasn't a fundamental issue. But anyway, I say all that to say conservative, which I have to laugh at a little bit, because who doesn't use the word conservative underwriting? But what does it really mean? I think we've all learned a lot of lessons on what we thought was conservative in 2021 turned out to be more aggressive. So how do we put that in layman's terms? Lower leverage used to be common that folks are putting 20, 25% down on a deal. I'm now looking for 30, 40% down as an example. Does it cash flow day one on its own as is? I'm liking the fixed rate debt right now. Even though rates are projected to go down by many economists, I still like the certainty that if it cash flows now, with this debt that's fixed, that we can always refinance or sell early or something down the road. But I don't want to take a gamble that the Fed reverses track 2 years from now and jacks rates up again or something like that. I don't like to see aggressive rent bumps. We had exceptionally high rent bumps in 21 and parts of 22. Some of our deals going double digit rent growth year over year. You can't project like that. Nobody should. Nobody that I've seen has per se, but I like to see 0 to 3%, somewhere in that range, just trying to be very, very moderately conservative. The Fed wants an inflation target of 2%. Rents generally move up naturally around the inflation, target. So, if you're forecasting 6% rent growth and inflation's 2, you may not get it. And then all those projected returns have to change. So, just conservative in general is
Yeah.
my primary point.
Yeah. No, that's That is the way to invest in other deals for sure. And I've seen a lot of deals sent to me where, especially from brokers, they'll project the rent increases way more than they should be projecting. And I'm just
Yeah.
like, how do you know you're going to be able to get, 2,500 bucks in rent when it's 1,500 right now in 5 years? That's just not going to happen. So
Yeah.
that is definitely something to look at. So that brings us to today. How are the deals looking? Do you feel like it is still, on our side, we invest in self storage and mobile home RV parks, and over the past 3 years, it's been very difficult to find good deals. But we feel like sellers are getting a little bit more open to underwriting that makes sense. Have you found more deals to be available, or how's your activity been?
Yeah, and I don't have the exact stats in front of me, but it's something like, the transaction volume. I mean, it fell off a cliff the last couple of years, something like 70% down from where it was in previous years, like 21, for example. So we're in the same boat. It's been really hard. I mean, we were doing consistently like 8 deals a year, every single year, like clockwork. And all of a sudden in 22, 23, 24, I mean, we got down to doing like 3 deals or less,
Yeah.
and to your point, yeah, I mean, it's kind of like if you're an owner going through that cycle shift and you're not forced to sell, then you're probably not selling, right? Because you're going to take a haircut. In our niche, it's about 25% off, pricing from 21. So why proactively do it? There's reasons people do. You're offloading or closing a fund, you're distressed on your debt and you have to offload it. The alternative is foreclosure. I mean, there's circumstances, but bottom line, we just bought a deal out here in Orlando where I live, about 12 miles from my house, below replacement cost as a Class A property, built in 21. And of course, the forecast and the hopes back then was that the market would be just thriving and booming today and that they would make a healthy profit. But the reality is it went the other way on them.
Mm,
So for us, we're typically Class B value add operators. That's nearly every deal we've ever done as a company. But this is an opportunity for us to trade up to a Class A property with a very minimal value add component to it, still a value add deal, and have that type of quality in our portfolio. And if the forecast end up being correct, that cap rates start to compress again and that interest rates come down and that the builders have largely pulled out, and so there's going to be this lack of supply hitting the market in a couple of years. We got a good case to be made for that deal doing really well. So that's kind of what we've been seeing. I wish we could find deals like that consistently and for the next 2, 3 years, but I just don't think that's going to happen. I think this is a very short-lived window of opportunity, maybe 6 months, maybe 12 months. I don't know. But these deals are going to get sucked up, and they already are from institutions. You see the Blackstones and stuff putting 10 billion plus out there in multifamily apartments this year alone. They're buying up the deals,
yeah.
as we are and as everyone's trying to do. So it's not going to be like this huge wave of foreclosures. I know a lot of people subscribe to the bearish sentiment year over year, but I don't think we're going to see it.
Yeah, that makes sense. All right, that leads us to the quick question round. Are you ready?
Let's do it.
Let's do it. It starts with education, two recommendations, one for general life wisdom, one for real estate. It could be a book you read, a movie you saw, a podcast you like, whatever. I just need two recommendations.
Yeah, so I was just about to send this to my nephews. It's called How Rich People Think by Steve Siebold. It's a really short book. It's like 100 pages, but it's really good because, if you're thinking like everybody else and like the masses, it's going to be really hard to set yourself up for major success. So it has a lot to do with mentality. I recommend that book. Tax-Free Wealth is one I read a long time ago by Tom Wheelwright. It just taught me how to think about taxes in a healthier way, other than being a pain point and something that I don't like doing.
I hate
So
taxes.
yeah, and so that helped lead me to hiring on a tax strategist. It wasn't him and his firm; it was another group. But the point is, how many potentially tens of thousands to hundreds of thousands have I saved by just embracing that kind of knowledge? It's been probably the single highest ROI on any books. So
Yeah.
those are two. I just released earlier this year Passive Investor Tips. It's on Amazon. It's about a 150-page book. It's 48 really short consolidated chapters, or like 2, 3 pages of just here's either the tip, the trick, the strategy, the formula, the story, whatever it is, why it's important, how you implement it. That's it. There's no fluff in that book. And so I'm very proud of making a book like that. So you can check that out. I'm donating all the proceeds to Joe Fairless's Best Ever platform that published the book, just to help that community grow and expand and put more knowledge out there for real estate investors.
Cool. We'll be sure to put that link in the show notes. So if you guys want to get it, just click a little more in the description, and it'll be down there in the full description. And yeah, about the tax-free wealth, I'm gonna have to pick that up because I really don't mind paying taxes. I like to keep a positive perspective on it, thinking that this money is actually going to the greater society. It's building up the society, all that kind of stuff. But I just hate the process of doing taxes. It is just a nightmare. And it's just, maybe this book will help me like get, have a better perspective on the process of doing taxes, because it is no fun for me, that's for sure.
Yeah, it was a whole epiphany shift for me because, I used to think of it only as a pain point, and like you, it was a mess every single year, and the money and the whole deal. But the point is to look at it like, the tax code really is just the government giving you the opportunity to reduce taxes and to help the government accomplish what it needs to accomplish. For example, they don't build multifamily apartment housing nationwide. So someone's got to do it. And so if you want to be that investor or that developer, you'll get potentially a tax benefit to do it. If you want to create solar or renewable energy, there's tax credits. If you want to do oil and gas, there's tax credits. So you got to look at it like that. You're partnering with the government. They're taking some of the risk off the table for you by giving you a tax deduction to get done what needs to be done. If private individuals weren't doing this stuff, we would fail as a nation. So you don't just have to be a W-2 handing it over to them, at the highest brackets.
Yeah, makes sense. All right, next question is for your younger self. Let's go back to the Travis who was just buying that. What do you say? It was a townhome way back in the
Yeah.
day, getting yourself that first roommate. Go back to him, look him in the eye, give him one piece of advice moving forward.
I would say double down on passive income as a study because I got very distracted for many years. As I mentioned, I did fix and flips and I did equity deals and I did some things that didn't produce passive income, but passive income is what created financial freedom. And it's what creates financial freedom for others, in my opinion, because how many people do we know with high net worths that go broke between
Mm.
celebrities and athletes and all the rest? How many people do you know with an overabundance of passive income that go broke? you
Zero.
know, so I mean, to me, that's just the only way to really look at it is, when your passive income exceeds your lifestyle expenses, you just have, if nothing else, hopefully a lot less stress in your life. And
Absolutely.
then to take it, 10 steps further, the ability to do so much more with your time and with your life, and to have that kind of time freedom.
Yep. All right, next question is about that 25% market that you mentioned earlier. The United States is a huge place. There is so much opportunity out there. Give me the single metro, the single market that you're most excited about investing in today.
Well, I'm a little biased because I live in Florida. I invest in Florida. We just did a deal in Florida. I love Florida, man. I lived in Colorado for a long, long time. There's some things I love about Colorado, but as far as a market and investments, I would love to do 10 to 15 more deals here realistically if I could, in the coming years. So, not to say it's the only place to be, not to say every market in Florida is good. I don't invest in Miami, for example. So do your homework. But again, the main thing is, where are people moving to? Is it tax friendly? Is it landlord friendly? And then choosing a good sub market within it.
Do you have a specific city that you like investing in Florida?
Not in particular. I've got deals in Jacksonville and Clearwater and Tampa, Sarasota, Fort Lauderdale, Orlando. So I like all of those, but I'm not purposefully trying to exclude markets in Florida, other
Yeah,
than
makes sense.
Miami. I'm just not a fan of Miami. Just
Yeah.
a personal preference, but yeah.
I haven't invested in Florida. I've been tempted to multiple times, but I haven't done it yet. But I've always, for some reason, the hurricanes, I
Yeah.
just can't get over it. Like Gainesville, maybe like in the center of the state, I might be tempted to, but the hurricanes down there, they're rough. I know that doesn't completely, discount an entire state, but it's
Yeah.
just one of those mental hurdles I need to get over.
Yeah, underwrite properly for insurance. I love being in the center of the state myself. Every time you got to think in layman's terms, every time, let's say a category 4 is coming in, it's going to hit Florida in some capacity. By the time it reaches Orlando, I mean, we've been here through so many hurricanes. It's usually a tropical storm, maybe a category 1, and that's not to suggest it can't happen or it won't happen in the future. I'm just saying our insurance is much better here. We're not dealing with the tide issues, and the eroding beaches and the global warming, rising tides, all this kind of stuff. It's just, that's why I like Central Florida. But yeah, to your point, there's Northern Florida too, and a lot of great markets out here. So
Yeah.
anyway.
All right. Next question is about finding the deal. I guess for you, usually I say you got to start a deal by finding the seller, but for you, you got to start the deal by finding the general partner. So, what is your favorite way to find new operators to invest with?
Yeah, so what I always say about being a limited partner, if you're going to do it aggressively or full time like I do, it's a very front loaded business. So, meaning you're going to have to put in the time and the homework up front to network and maybe go to conferences and listen to podcasts like yours and read the books and just meet people. But after doing that for a couple years, in my case, more like 3.5 years, I'm good now. Like I see way more deals than I'll ever have the capital to put into them. You know what I mean? Like my pipeline is full. So now it's a pretty easy business. I know how to vet them. I know my criteria. I know the operators. Now it's just choosing. Do I want to do that one or that one? That's really it. And then you sign your docs and you do your stuff, and then it really is a hands-off venture from there. So I started with online forums. I started with local meetups out in Denver, Colorado, and Boulder, Colorado. Then I started going to national conferences like Joe's Best Ever Conference in Salt Lake, and back then it used to be in Denver, and just kind of scaled from there until I felt good. I felt like I knew, the key players and how the industry worked, and I saw my deals going full cycle, and I just I fell in love with the business model.
Is Joe Fairless? Is he out in Colorado?
No, he's out in Ohio with his wife because they have family out there. But he hosted the Best Ever Conference in Denver for many years and Keystone one year. And that was all during a time I lived there.
Mm.
And then now they've been in Salt Lake City for the last 2 years, and they will be in 2025 as well. So,
Nice. I've been
yeah,
meaning to go to that conference. The only one I go to is the self storage one, but I've been meaning to go to the best ever one. It just seems like there's a lot of
yeah.
good, it's a good lineup for the people that speak, and a lot of people go to it. So it seems like a
A
good
lot
one to
of, lot
join.
of active, a lot of passive, a lot of great speakers, economists, all kinds of asset classes. It's not just like a multifamily deal. It's not Joe up there pitching himself or Ashcroft. So it's a great conference. Yeah, I've been for many, many years now. So
Cool. All right, next question is about lessons learned. Not every deal we get into goes the way we expect it. In fact, most of the deals, at least something goes a little bit sideways, but that's
yeah.
when we learn our best lessons. So, what was a deal that went a little sideways for you, and what was the lesson you pulled from it?
Oh man. Yeah, there's been a handful. The way I look at being an LP in so many different deals is kind of like someone who's picking stocks, and they want to be a stock investor. And so the point is, some of those are going to underperform, some are going to perform approximately at expectations, and some are going to be outperformers. And don't we all wish we had a crystal ball up front, but I don't. So I had a deal. I'd go back to that one I shared earlier on the podcast from 2016. we had the wrong property management company, we had the wrong operator in place. We were in a great growing market, so rents were going up, like in a turnkey fashion. We hoped to get about a 20% IRR out of that deal annualized. We ended up with more like a 10, but can't complain. Lots of lessons learned. But to your point, there's always a kitchen fire. There's always a flood. There's always a tornado, a windstorm, a hailstorm. Like things are going to happen. So have the right insurance in place, have the right cash reserves in place, and be partnered up with a good operator that's competent in what they're doing.
All right. That leads us to the last question. This is for the listeners. You've given us a lot to think about, so I'm sure people want to get in contact with you. This is a two-parter. Where can they find you, and what can they expect when they reach out?
Yeah, you can now go to speakwithtravis.com. Pretty easy URL to remember. And that's my calendar link. I do 15-minute calls with anybody and everybody across the board, across the globe for that matter. I've been doing this for years, and it's very rewarding. If I can't help you directly with something, I can at least help point you in the right direction. Happy to make introductions for you. I put a lot of content out there, so people reach out for all different types of reasons. So speakwithtravis.com. There's also some downloads on there. You can also check out what deals we're working on that are live with Ashcroft Capital. So yeah, reach out. Love to be a resource.
All right. And again, I will put those links in the show notes. So if you guys want to reach out, just click a little more in the description. It'll pull down that full description in there. You can find Travis's link. All right, man. That wraps it up. Thank you very much for hopping on the show.
Thanks, Gabe. Thanks, everybody.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.